If the attendances follow this session correctly, they will understand how we will build up the yield curve. Okay, this is the return. And this is maturity. This is, let's say, 1 year.
Abdulkadir, can we ask a quick question for you?
Yes.
In some countries, people do not trust the banks. Have you had that? Have you seen that in your own country or other countries?
Don't trust the banks, you mean?
Yes. They don't
Yes.
want to put their money in the banks because the banks will charge the money and not
Yes.
give them interest.
This is exactly true, because especially in some countries, first, the trust is something else, but the return is something else. But let's focus on the trust side, Dr. Lambert. Trust is this. If you are in Lebanon, lots of people attacking to the banks, the deposit banks, to take their money back. But the banks are closed. They are not giving the money back because they don't have enough liquidity in the banking system. Because lots of money transferred to the international money market, they don't have liquidity in their branches. So the trust issue is coming from this side. But another thing is this, like in the Switzerland, like in the European banks in the 2022 and 2023, they are giving the negative interest rate, meaning that you are putting $1 million, but at the end of the year, they are giving approximately $999,000. You are losing money in the bank because of the negative interest rate. So nobody wants to put their money in the banking system because you are losing the money because of the negative interest rate. But the trust is something else. Even they are giving the positive interest rate return, you are not taking your money back because of the trust issue. There is no liquidity in the market, like in the Lebanon. Please write in the Google Lebanon banking system. People on the street attacking the Lebanon banks because they are not able to give the money back because money is not there in the branches. Okay, please look at this chart.
So then you're going to give some options for fixed securities or fixed income that people can trust internationally?
Let me say this. For instance, if you don't have financial market deepness, this is important, because why the Saudi savers, people, put their money in the United States equity market, but not in the Morocco financial market? Because in Morocco, in Algeria, in Lebanon, in Saudi Arabia, they don't have enough deepness in the financial market. They don't have enough securities in the financial market. Somebody can come with $50 million and easily manipulate all stocks, sell and buy easily, and can get a return in 50% in 1 hour, like a Bitcoin, like a cryptocurrency. So people don't want to take this type of risk in the less deep market in the financial system. For that reason, people bringing their money in the deepness of the financial market. So if you are living in the less developed countries, and if you follow from the news that your banking system is not secure enough to save your money, so you should put your money in the secure financial market. I kind of request from the attendances, please don't move your markers in the blank page because you are directly, please don't do this. Friends, you are moving your mouses and you are drawing the lines on the blank page. Anyway, let me open a new page. Please don't move your mouses. Please, I kindly request it from the attendances, okay? This is return in financial market because I will show the fixed income logic to you. Oh my God. Ladies and gentlemen, please don't move your mouse on the screen. This is return and this is maturity in the financial market. And here maturity is 1 year, 2 year, 3 year, 5 year, 10 year, and 30 year. Okay. And we can have a yield curve like this. What does this mean? This showing us that, let's say this is 3%. Let's say this is 3.5%. Okay. There's a question in the chat side. Let me check the question first. Okay.
Yeah, it's more about the people don't trust the banks.
Yes.
So
yeah. Okay. This is in African countries. Banks are not trustful. There are scenarios whereby some government officer institution always embezzle the money from the community and individuals. Do you know the small saving group that pool their money? Okay. Let me explain your question first, then continue with the maturity side. As I said, if you are living in Africa, let's say if you are living in Mongolia, let's say you are in Bhutan, in a small country, and government officer, financial market money maker, or decision maker can manipulate and can guide the people easily to put their money in an untrusted fund, in an untrusted bank. So what does this mean? That banks don't have enough IT infrastructure. They don't have enough public saving, and they don't have linkages between international money market and domestic saving. For that reason, they don't know after they collect the deposit, they don't know the way and the style how to invest those money in the efficient investment schedule and get the return and pay the depositors. For that reason, if they collect the money and if they don't get the enough return from the investment, they will not satisfy and fulfill the responsibilities to the deposit holders. What is the option now? They will send the money to another international account, and they will reply to the investor or depositors as they don't have enough money today, and they will pay in the next couple of months or next couple of days. For that reason, if you are putting your money in a less developed country, in a less developed financial market, you are absolutely should be really, really careful. Okay. Otherwise, you can even lose all of your money, all of your investment because of the untrustful banks or their managers. Okay. They can even transfer your money to another bank account, and you cannot even request to take your money back, even lawfully. Okay. For that reason, I'm underlying and emphasizing that if you are putting your money in an investment fund, in a bank, you should first check the bank fulfill and satisfy all the conditions for the international banking system. For instance, let's say you have $100,000 today in your deposit banking in African countries. Then, after 3 days, you want to send your money, $30,000, in a Germany account. So, if your banking account and banking system is not transferred and linkage with the SWIFT payment in the international money market, they even cannot send your money to the Germany. because they don't have eligibility, they don't have enough requirements, they couldn't satisfy the prerequisite to send the money to the international money market. So you should check everything. If you don't feel satisfactory about those requirements, you should put your money in the developed market banking system. At least their return are less, but you can get your money at the end. So in economics and in financial system, we are saying that one bird at hand is better than 100 birds at the tree. Okay, one bird at hand is better than 100 birds at the tree, because in the developed market you have one bird at your hand for sure, but other 100 birds on the tree, you cannot even catch them all. Now let me share my screen again.
We can see your screen.
Hang on a sec. Now everybody can follow my fixed income screen, right?
Yes, we see fixed income market dynamics.
Exactly. As you see here, the 2-year treasury yield is positive, but others are full of negative. Why? Because if Dr. Lambert put his money into the United States treasury yield, what does mean treasury yield? By the way, what we mean by fixed income? Fixed income is risk-free asset. Okay, risk-free asset. For instance, if you buy oil, Brent oil in the commodity market, if you buy Amazon or Apple equities in the Nasdaq or Dow Jones, you are taking a risk. There is a risk. If the price goes down, you will lose the money. But in fixed income, these are fixed assets. These are risk-free assets. You will not lose your money. Okay, but what will you use and what will you lose? You will lose at the end the time and the maturity. So if the Dr. Lambert put his money in the fixed income securities in the United States, and if Dr. Lambert knows that the United States inflation rate today is around 3%, and if the Dr. Lambert believes that 10 years after the inflation rate increase, what the Dr. Lambert should do? He will request an increase in the yield, because he will lose money because of the inflation during 10 years, right? So he will request from the bond publisher who are sending the bonds in the financial market, he will request an upside in the return, because Dr. Lambert during 10 years will lose money because of the inflation, right? Inflation will decrease your return, your net return. So if the 2-year treasury yield is positive, this meaning that inflation will rise in the 2 years, but inflation will decrease after the 5 years. What does this mean? Investors believe that now, after the 2 years, all inflationary pressure in the United States will decrease. For that reason, in the 2 years, during the 2 years, because inflation will increase, they will increase their return and they will get a positive return. But after the 2 years return, they will get a negative return because inflation will decrease. You can think the fixed income and yield curve dynamics in this style. The main dynamics behind the screen here is that because of the inflationary pressure in the financial market, the investor will request a higher return in their fixed income securities. But if inflation pressure will decrease, then the long-term yield curve will decrease as well. Now, as you see here, we have lots of other alternatives to the US treasuries. What are these? These are the sectors: US aggregate, investment grade corporation. What does this mean? Investment grade is, we have credit risk agencies, right? Credit rating agencies like Moody's, S&P's, or Fitch. These are the credit risk agencies. And these are giving the grades for the companies, sectors, even for the countries. And they are saying that this company has AAA, or this company is BB plus. So this investment grade showing that you can put your money because these companies can satisfy the condition to put the money as investment. But if the grade is less than BBB negative, so BBB, BB minus, or CC plus, CC, or D, default, these are all non-investment grade. So this investment grade corporation like Amazon, like Apple, like Microsoft, these are like the governments. So less risky asset. Convertibles, US high yield bonds. High yield bonds meaning that you have some bonds, but some have high yields. They have a little bit higher risk assets. And the municipal bonds, lots of municipalities publish the bonds to increase their finance, right? They need money and they publish the bonds. For that reason, they have some municipal bonds as well. Mortgage-backed securities and asset-backed securities. These are the most popular, two most popular assets during the COVID-19 crisis, which the United States, also European Central Bank or Bank of England and Bank of Japan are making a quantitative easing, buying mortgage-backed and asset-backed securities from the market. Please look at the chart on the right-hand side. What this chart is showing us. The x-axis here showing the return and the impact of a 1% rise or fall in the interest rate. What does this mean? If the official interest rate, policy rate, central bank, federal open market committee operations, central bank interest rate, this is policy rate of the Federal Reserve. If this increase 1%, what will happen to total return of the assets? Okay, this will show us the total return of the asset. As you see, these are assumes a parallel shift in the yield curve. 2-year US Treasury bond, 5-year US Treasury bond, Treasury inflation protected securities, 10-year, 30-year US aggregate, investment grade, convertible, all these are here. So the blue one is 1% fall, and the gray one is 1% rise. So think this. You should understand the logic from this one. Let me share this. Hang on a sec. Everybody see the white screen again, right? There's a white screen here.
Yes, we can see that.
Okay, perfect. You should understand this. Money supply plus bond supply equals money demand plus bond demand. So supply is equals demand in the financial market. So if I collect money and bond in the same side, this means that money supply minus money demand equals bond demand minus bond supply. So please look at this one, the second one. If money supply increase on the left-hand side, what should happen here? This side should be increased, right? So if money supply increase, look at this one. This is my IS-LM curve. This is my IS. This is my LM. This is my interest rate. If money supply increase, LM shift right, and interest rate will fall. Okay, the new equilibrium here. First equilibrium here. Because of the money supply increase, interest rate decrease. And if interest rate decrease, bond demand increase. And price of the bond increase as well. What should you know at the end? Price and interest rate of the bond is negative correlation. If the price of bond increase, the return of the bond decrease. Okay, this should be keep in mind. Now, let's turn back our screen again and look at the chart here. If there is a pole, look at this one, blue one. As you see, if there is a fall in the interest rate, price of the bond will rise, right? As you see, the blue one, always rising. In the longer return, it is rising higher than that. If the interest rate decrease, price of the bond will rise, right? So you will get higher return. You are buying a bond with a price, but if the interest rate decreases, its prices will increase. You will get this much return. In the 30 years, in 10 years, your return will be like this. Or in 5 years, your return will be like this. So you should keep in mind that price of bond and interest rate of bond has a negative correlation in the financial market. Now, this is my yield curve. Okay, you should keep this yield curve in this style in mind. That please investigate the chart first. I will explain the details. What's happening in the charts and what does this mean if the inflation increase and the yield curve has a negative slope, or inflation increase and the yield curve has a positive slope? Look at this one. Do you see this one? Yes. As you see, 3 months here, 1 year here, 2 year here, 3 year here. What does this mean? As the maturity increase, my return increase because inflation will increase in this market. But please look at this one. What does this mean? In 3 months, the return is here, but after 7 years, return is here. Short-term yield are higher than the long-term yield. Long-term yield is 4.2, but short-term is 5.4. What does this mean? Because inflation will decrease, your return will decrease in the long run. Okay, so if you expect in the financial market, the inflation will increase in the long run, your yield curve will have a positive slope like this. Your return will increase because of the inflation. But if the inflation is negative and will decrease, you will understand that your yield curve will decrease. Let me share my screen and you will better understand what's happening there. Hang on a sec. Give me 1 second. I will share my Bloomberg screen to you. And you will better understand what's happening there. Here, can everybody see my screen?
Yes. Yes, we can see the screen.
Perfect. A Bloomberg screen.
Yes.
Hang on a sec. Here you are. Please look at the screen now. This is showing the current and active United States Treasury active curve. Okay. And as you see here, 1 month, 4 months, 1 year is positive. Then in 4 or 5 years, the return will decrease suddenly. What does this mean? In 1 month until the 4 year, market until the 1 year, from 1 month to 1 year, as you see. Market expect that there is an increase in the inflation during 1 year. But after 1 year, look at this chart. During 5 years, inflation will decrease and the yield is decreasing. Okay, please look at this one. For instance, if I compare this chart with the, let's say, COVID process. Do you see the curve now? In the 2020, the curve is like this. Or in 2018, the curve is like this. There is no negative slope in the curve. As you see, the curve is like this. Positive. The green line. Do you see? This green line is in the 2018. The United States Treasury always increasing. What does this mean? I'm expecting an increase in the inflation rate. But right now, I have a problem in the inflation. So I don't want any relative comparison. So today, as you see, hang on a sec. Now I'm sharing my screen again. I think everybody see the yield curve now, right? So 5 years ago, yield curve is like this, but now yield curve is like this. What does this mean? Because Federal Open Market operation is really successful to decrease the inflation in the financial market. For that reason, the yield curve has a negative slope. In the long run, I'm getting less return because there is no inflationary pressure in the financial market. And this one is high yield bonds and default rate and the spread to the worst. Please look at here, the blue line. By the way, this gray dash line, this gray dash line, this and this are the recessionary period. This is COVID-19. This is global financial crisis 2008. This is dot-com crisis in the United States, and this is gold crisis. These are the recession period. And the default rate in the long run average, and today, as you see, the blue line is the default rate, and the recovery rate and the spread to the worst. What does this mean? High yield bonds, especially in the recession period, have huge return. But today, as the market converges its long run dynamics, they are decreasing their overall return in the long run. But as you see in the COVID-19 crisis, it's approximately 10%. In the global financial crisis, it's approximately 18% for the high yield bonds. And the credit maturity and the default risk in the fixed income securities. Please look at this one. I explained the investment grade. Those three rating agencies, S&P, Moody's, and Fitch, they are giving the grades for the corporates. And according to those grades, you can understand which one is investable and which one not. Okay, so with this investment grade, you can put your money. And this one is high yield. As you see, high yield, these are the maturities. Okay, high yields until the 5 year has higher return, but investment grade in the long run has lower return because you should keep in this mind as well. Investment grade is less risk and high yield is really, really risky asset. If you have risk higher, your return will be higher in the financial market. If you have less risk, your return will be less. Volatility will increase your return, but they will increase your risk as well in the market. Okay, while you are taking risk, upside and downside risk, your return will be correlated with those volatilities as well. And on the right hand side, as you see, index rating, credit rating, look at these grades. What I say to you, BBB, AAA+, BB-, B, or CC. These are the grades. in the corporates with investment rates. And these are US high yield default rates. Default rates meaning that you can go to a bankruptcy. Okay, the default rates. These are the threshold level for the income in the fixed income valuation. Look at this one. These are showing yield to first fixed income securities. These are, please look at this definition. The gray one is 10-year range. The purple one is 10-year median, and the blue one is current rate. As you see, US Treasuries 10-year range is just between 5 and approximately 0.5. But the municipals have higher range. Or let's say mortgage-backed securities is higher range with the comparison to US Treasuries. Why? If we compare these 6 assets, the less risky one is the US Treasury and Euro investment rate. Why? Because at the back, the Treasury is there. No risk. But for instance, in investment grade corporation, the corporation and corporates can go to bankruptcy, but the Treasury cannot be go to bankruptcy. For that reason, they have less risky and their return is less. And here, as you see, these are emerging market defaults, emerging market corporate, Euro high yield bonds, US high yield bonds, and leveraged loans. As you see, leveraged loans have really, really high return, and their range is approximately 14%. What does this mean? If you want to take a risk in leveraged loan, you can get a really high return, approximately 14% in a year. But you can go to bankruptcy as well. There's a risk there. Here, I want to emphasize the monetary policy in the developed market as well. The developed market monetary policy. You can look at this chart on the left-hand side. These are the developed market central bank bond purchases. What does this mean? We have in the central bank, we have assets. This gray one is the Federal Reserve. The dark blue one is Bank of Japan. The light blue is European Central Bank. The light blue is Bank of England. And the total asset in central banks. And this is USD billion, or if you skip the zeros, this is $1 trillion. And as you see here, the total one rolling. Please look at this one. This is rolling. Okay, not today. This is 12-month rolling. And after the COVID-19 crisis, the total asset, please focus on the orange line. Total asset, total buying in the 12-month rolling is negative. Why? Because central banks end up the quantitative easing period. They started a quantitative tapering period. They are selling the assets from the central banks. They are not buying from the market, right? They are selling. Because during the COVID process, they buy the asset-backed securities and mortgage-backed securities from the market. They collect approximately $20 trillion in their central bank assets. Then, after the inflation controlled and the interest rate increased, they started the tapering process, and they say that we will not increase interest rate higher than this, and we will sell the asset-backed securities and mortgage-backed securities to market again. Then we will collect our dollar and euro to the central bank again. So the total asset in the central bank on the orange line, as you see, decreasing. Why? Because they are not making quantitative easing anymore. And historical policy rate and forward curves in the central bank, as you see here, Fed, European Central Bank, Bank of England, and Bank of Japan. Today, the Bank of England and Federal Reserve interest rate is really high, approximately 5.5%, as you see here. We are here. Okay. Federal Reserve today 5.5, and the Bank of England around that. The European Central Bank started to decrease the interest rate. They are here, and they started to decrease interest rate in June with 25 basis points. The first central bank in the world, they are decreasing. The big central bank, I mean, not just one central bank, but in the biggest central bank, the ECB is the first one who is started to decrease their interest rate. What is the most weird issue here? The Bank of Japan. Look at this chart. All central banks decreasing their interest rate, but the Bank of Japan increasing. Why? Because after 20 years, Bank of Japan can achieve to create an inflation. Because during 20 years, from 2000 to 2020, Bank of Japan always struggled with the deflation problem in the market. They are not creating an inflation. Price is always going down. There is a deflation there during 20 years. But right now, they achieve to increase the inflation. And for that reason, they will increase the interest rate to decrease that inflation. Because after 20 years, they create an inflation at the end. To decrease that inflation, they will increase the interest rate in the long run. You understand the logic, right? But the other central bank, as you see here in the chart, will decrease the interest rate because inflation is decreasing. We reach in the United States 9%, in the euros 10% inflation, but now they are around just 3%, 2%. For that reason, interest rate will decrease. And now, as you see here, we are comparing the global fixed income. The first quarter, as you see, the US, the global market excluding the US, Japan, Germany, United Kingdom, Italy, and China. And here, if you compare the sector, Euro corporate, Euro high yield, emerging markets in the USD, or emerging market in local currency, or emerging market corporates. Please look at the return. The return only in China and Italy is positive in their local currency. But in USD, almost all return in the first quarter is negative. Why? Because inflation is decreasing. The treasury yield will decrease as well. On the right-hand side, you will see the global bond market, the USD trillion. Do you see how much it is, the total? $140 trillion global bond market. Think this. The Germany or Italy have just $5 trillion gross domestic product. This means that approximately 30 Germany is in the global bond market. 30 Germany, or 50 Italy, or 40 United Kingdom, or approximately 6 United States are in the global bond market as the GDP. Huge market. $140 trillion. Huge. And the municipal finance here, municipal tax equivalent and treasury yield curve here. As you see, as I say, in the short run, and especially after the 5 years maturity, we will decrease the yield curve, but after that, the inflation will start to rise again, and the yield curve will rise again as well. And these are the grades, BBB, AAA. So you can ask this question, why BBB has higher return than AAA? Because BBB is higher risk. Higher risk means higher return. AAA is less risky, so their return will be less. Okay, if you have higher risk in financial market, your return will be higher because your loss can be higher as well. On the right-hand side, we have federal state debt, and this is huge. Please look at this one. Approximately 96% of the GDP. Huge money. On the right-hand side, this is default and municipality corporate rates. This is really, really higher for the default risk, but for the really low rates in the AA or AA plus grades in the municipal rates. And the last two slides, Bloomberg US aggregate annual return. Please look at the year here. This is 1970s and this is 2020, approximately 50 years we have. And as you see, lots of higher return we have and lots of losses we have. Here, after the petroleum prices, we have huge yields. Here, as you see in the COVID crisis, we have really huge loss, 13% in 1 year. But around 10% and minus 10%, we have an average in the aggregate return of the fixed income securities. And the sources of the bond total return, where the total return coming from in the bond yields, the blue, dark blue is saying that change in the treasury yield, light blue same change in the spread to the treasuries, and the gray line showing the coupon changes, and the black one is total return. As you see, during the COVID and after the COVID, we have huge loss, as I say, 13%, because of the increase in the interest rate. What we say, if the interest rate increase, the price of bond will decrease. Okay, you will lose the money. But here, we expect the interest rate will decrease and you have a positive return in the bond market. And now the last slide. Valuation monitor. These are the asset classes and valuation in the financial market. These are the Z-score based on the 25-year average valuation measures. This light green showing the January 1st, 2023, and the dark green is showing the current rates. And these are the different branches: treasuries, US core bonds, emerging market equity, municipalities, developed market equities, but excluding the United States. This is US small capitalized firm. This is US high yield, US value firm, and US large corporate. What does this mean? As you see, treasuries, because they have less risky, have smallest return in the financial market. But if you have high yield, as you see, their brand is really creating high return in the financial market as well.